Okay, welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Jung, Head of Investor Relations here at Focus Capital, and I'm joined again by our VP of Investments, Chad Olson. Thanks for joining us last week and this week again. Let's talk about stress testing. So most deals look good on paper, but the real question is what happens if things don't go as planned? Obviously, we're not going to invest in anything that looks bad on paper. So today we're going to break down how to stress test a real estate deal and which assumptions actually matter. Let's start off simple. What does it mean to stress test a deal?
It's taken into, you have the model way of doing it, and then you have the kind of knowledge operating base of doing it. But for the model side of things, maybe it's been covered before, but like the big drivers of it are, what you can set your rents, what you can set your expense ratios to, but your cap rate, your rent growth assumptions, exit terminal cap rate. So you every 25 bips is huge gains that can be made. And that's the difference between winning and losing a deal. But you can manipulate those factors. And so you're always evaluating those factors. And it's like, okay, if these things turn out one way or the other, how does that go? What you can never fix, though, is the buy, right? And that's what we're extremely focused on, is the basis that we get in it, what we enter on the buy, cap rate that we enter in on the buy, or what we can reasonably achieve in a very quick amount of time. We don't know what's going to be going on 3 to 5 years from now. They're all just guesstimates, but we know what we can control within the first 3, 6 months and a year. We're pretty confident on that. So we work with our property management teams, get them bought in early, or asset management team, got them bought in early. Okay, here's what we want to do on expenses alone. What do you think about these assumptions? Do you think they're realistic? What are they going to be now? What are they going to be 6 months from now, a year from now? Okay, agreement there. And then where do we think we are in rents in the market? We do a big rent comp analysis that's usually included in the OM. And we try to give ourselves a pretty good cushion between whatever our comp set is and being not the highest in those, even though if we're going to provide a higher quality product at the end of the day, but we built that in. And then, obviously have a gap between us and the newest comp if it's a value add deal. So it starts all from there. And then our growth factors, right? So what has rent growth historically been? We've obviously lived through the last 5, 6 years of it being a little crazy. So we really need to take in realistic assumptions. We might start with a 0% rent growth right now. It's very typical to try to start from there. And then looking at our various data sources to find out what kind of rent growth can we expect going forward. But still, we like to stay around that 2 to 3% range in most cases. Then we shift down to expenses, right? And what our expense growth factors are. Those have been all over the board, right? If you have really solid and really tight controls and a good asset management team, you can keep those brought in. But we have data sources from the brokerages where they, show pretty typical of it 5 to 6% over your total expenses increasing. Now, what are the biggest drivers of that? Insurance and taxes. And so in protecting ourselves there and looking at stress testing different things, we get with our insurance broker, we get with a independent tax consultant early and do all those things. And so we bring all of that together in the model, and then it's scenario analysis over that time of, right? So we put in different sensitivity analyses that show, and it's not overly whelming, it's just a table, right, of taking 2 or 3 inputs into the model and changing those and seeing what happens. So rent growth, expense growth, cap rate compression or expansion, purchase price on the front end of what we're making do, and looking at all those things. And what we're really trying to figure out is, okay, if everything went wrong and didn't go the way we expected, could we still return capital for one, and then probably produce some kind of a return? And hopefully that's in the high single digits to low double digits, right? And if it all goes to crap and that's still the case, we probably will be okay. Because we're going to do everything we can to make sure that doesn't happen. And so then that leaves for the upside. And we already, as I said, laid out kind of what we do just from the start to make it conservative and the returns that we're showing, and leave ourselves room to ride it up to the upside and make sure we're making the right and best investment decision.
Yeah, and we'll go into some of those more technical things you talk about: rent growth, exit cap rate, debt and rates. And we'll break that down a little bit further into the episode. But I think that it's fair to explain to people high level is not just testing what is needed to make the deal work, but also what breaks it. And then, like you said, and if we're okay with it, and if we're going to be okay at that level, then the upside is going to be that much better. And then we're also going to be able to control it when there's things that are outside of our control, that risk mitigation factor. But I think the other question that I have following up to what is stress testing, and we kind of touched on this already, is like, why is stress testing such a critical part of underwriting? And things that I would like us to kind of pay attention to with this answer, especially given our last episode, is like market changes, the assumptions that rarely play out perfectly, and then also the downside protection versus the upside projections. So why is stress testing such a critical part of underwriting instead of just like, do these numbers work from a financial perspective?
The stress testing says the likelihood of the deal's performance, and you're stress testing to find, is this a good deal? Because you can underwrite anything, or you could do a surface level go and it's like, oh, this seems like a good deal. The basis is right. The cap rate's right. But if those risk factors that we kind of talked about, in last week's episode about what makes a good market or what makes a bad market, if those risk factors are there and that doesn't play out, then that's not as good of a deal, or you want to be compensated for the risk, right? So stress testing tells you the level of risk that goes into the deal and the return that you should expect to get from it going the way that you want it to go. It also shows you the ways that it can go wrong ahead of time. Well, it doesn't, but it gives you an idea of, okay, these are the few things that could go wrong, or these are the things that can move the needle very much. And like, how do we get ahead of these issues? How do we look into them and vet them out, whether that be a supply problem, whether that be a competition problem, and all those other things. But there is, at the end of the day, only so much you can do on that front. And that kind of goes into what I said at the beginning, which is, then it's the operation side. And so you need your PMs, you need your AMs that are familiar with markets, familiar with deals and their progression through, because there's nothing to stop you from a new ownership group coming in to a market and cutting rents on a property. And that you can only test your model with assumptions and rent growth and where your rents end up, but you can't like predict that, right? But you have to be able to adapt to it. And on the other side, you could have someone come in and upgrade the units quite a bit and push the rents to new high levels, which gives you a lot of room to come in and undercut them. So it's a double-edged sword on all those things. But
yeah, I think the two biggest words that I pulled from that is like the assumptions of predictability. I think good underwriting isn't about being right, because you can't be right. It's about being prepared.
Yeah.
And so when it comes to that preparation, knowing what our core sensitivities and main variables are, you had mentioned rent growth, exit cap rates, interest rates, occupancy and such, vacancy, and expense growth. The three things that I kind of wanted to double tap into is one you just mentioned is rent growth. So why is this such a critical assumption, and why do small changes like a $20 rent growth per unit make such a big impact? And then why are some people so overly aggressive on certain projections?
Your performance of your driving NOI and the cap rate is what, creates that exit value, which pushes so much back to the investment and what the returns look like. Cash on cash is extremely important and can generate it and stuff, and it hits that too, right? But that's your main income, right? You can increase other income, you can increase all the other stuff, but you're still talking about in sheer dollars a much smaller percentage of the overall pie of what makes up NOI or what makes up a deal. Rents are the deal. Rents are what makes everything going. So they're the biggest top line number that if you affect change on those units, $20, was it $20 on $100 units or 200 units? That's a big scale. And then what is that in percentage terms? And then when it happens too. So if I put 1% rent growth in year one or 0% rent growth in year one versus 1% rent growth in year 5, huge differences if I'm compounding that, right? So that big factor in the front end and trailing it off is a very different outcome than the back end. And it just makes or breaks deals, or makes or breaks offers on deals on what you assume your exit cap's going to be. And you got to watch it, right? So it's like some people are focused on the $20 increases or so on and so forth, but most of the time we're all focused on percentage increases. Mm-hmm. And if you just throw in willy-nilly a 3% rent growth kind of flatline, you might think that that's conservative, but then you start looking at, okay, well, we're going to move our rents from $1,200 to $1,500, which seems reasonable. But after 5 years of 3%, those rents might be $1,800 for an older vintage asset. And you just got to really ask yourself, will they be there when we get there? And I don't know if the answer is yes or no. Um, but because it's so easily manipulated, that's what's driving it. Obviously, your expenses it goes hand in hand with your expenses. So a lot of people will talk, a lot of banks and a lot of other things will always ask, or even investor groups that we get into, it's like, okay, well, what happens if you do 0% rent growth throughout? And it's like, okay, well, I'd love to answer that question, which is it's not going to be a good deal and it's not going to be a good return, which is my first surface level because you don't need to think about it too much. But am I also putting expenses at 0% growth? Because if you're telling me my income's not going to grow at all outside of my rent changes, but my expenses are going to continue to grow over the time of the deal, it will be worth less at the end of the story. And so it's not a good investment. So those things have to go. And expenses are not going to stay at zero or go negative, most likely. They're both going to increase somewhat. The problem is when operators don't operate, right? And then are letting expenses get away from them while also not increasing rents because they're not staying on top of it, or their occupancy is suffering, or economic occupancy is suffering because collections and bad debt and some of these other things that are going on. And that would be another factor I don't think I mentioned, which is like bad debt and collections, concessions. If it's a heavy concessions market, testing that, a lot of people like to just put in 0.5 and 0.5% into both, right? And it's not a wrong answer. It isn't. Just you got to look at the whole market. And if the deal is offering a ton of concessions to keep current occupancy, do you think you can actually achieve the rents that you're projecting? And if you do achieve the rents, are you going to have to offer more concessions than what you're projecting? And then as you transition a property, maybe from a affordability standpoint or a lower rent to a higher one, are you going to experience more bad debt during that time and then be able to stabilize your tenant base later? But yeah, rent growth is one of those biggest drivers, but you need it to be in it. And then, you can see a lot of people who will put in much higher rent growth assumptions, and that's why they're able to pay higher up for a deal. But when those things don't happen, the compounding effect that you see from putting 2 or 5% in year one, it's the opposite effect if you don't hit it, right? So then reality starts catching up with you. And if you're not hitting the rents, not hitting the rent growth that you were projecting, you are digging yourself into a bigger and bigger and bigger hole that you won't be able to get out of in a very short amount of time when you're 2 years into a deal and have 3 years left and you have to climb out because it's compounding the other way.
Yep. Let's talk about a little bit about debt. We talked about bad debt when it comes to like occupancy, but let's talk about debt and rates. How does debt structure factor into stress testing? Primarily like fixed versus floating, interest rate exposure, and refinance risk.
Yeah. So we at Focus Capital have typically gone for fixed rate debt or some sort of swap structure that negates the effects of variable rate debt. Just what we've seen before. I can't sit here and say that we will never take on a bridge loan or a variable rate debt loan. If we do construction, you usually have to. You can use swaps to do it. And we're in a better position than we were 4 or 5 years ago in the teens. That was the time that you should have been locking up all fixed rate debt, but people wanted bridge debt, took on a lot of risk, and then the rates rose above them. Now we're kind of in a flatter area. They could go up, they could go down, they could go sideways, but we're in a pretty equilibrium mark when I think rates are right now. And you can reasonably predict where they're going to end up or be around the margins and be okay. And you have potential for it to go down, you have potential for it to go up. So we like to do that. We also like to look at the deals, and depending on what they are, that's the structure that we kind of take on, whether we go direct to an agency loan, which is non-recourse, it's the lowest rates, decent leverage. It's not going to be the best leverage, which then means more equity coming to the table and reducing returns for investors. We do want to push the leverage. We don't want to get crazy 80, 90%, but we want to push it as much as we can that's comfortable and meeting the DSCR. And so there's that. And then we have our bank debt on other deals that allow us to go through transitional periods while keeping that interest rate risk low. So it's figuring out what the best debt instrument is for a deal, depending on the deal and the status and what kind of business plan we're trying to execute. And then going in the next level deeper, it's like, okay, well, with a fixed rate debt, that's, what the rate is during that time. And so you can reasonably predict, okay, here's our cash flows. And that's the lenders using those same stress tests that we are, debt yield, debt service coverage ratio, and our break-even occupancy, right? And so we're always checking at that. And that's the biggest one. We can get uncomfortable when we see break-even occupancies that are in the definitely mid-high 80s or 90. If it's like a 90% break-even occupancy without a really clear story about why that is, we're probably going to say no to that deal because it's just no margin for error right there, right? If you dip it's not unreasonable to be 93% occupied right now. That's kind of going back to the norm. So that means that if you have 1% bad debt and 1% concessions, you're already there, right? And that's a very uncomfortable position. So we want to see like definitely low 80s, go into the 70s over time for that, which then translates back to the DSCR and debt yield.
With working in investor relations, I think the biggest thing for me is people want to look at the return on their investment. Obviously, like they're not giving us money for nothing. They're wanting us to be good stewards of their money. We talked about how we do conservative underwriting, but one big thing that we haven't talked about yet that you briefly mentioned is exit cap rate. How do you think of exit assumptions specifically when it comes to cap rates, when it comes to cap rate expansion risk? Market uncertainty at exit is a big question that I get. And then often people underestimate, what that exit cap rate is.
Yeah. We look at it a couple different ways, and it's not like it would be easier if you could just say cap rates go up 25 or 50 bips a year for the hold period, right? And that's how it goes. But you would be leaving a lot on the table or missing a lot of opportunities, or any of these other stories that kind of come in with it and stuff. We could have cap rate contraction. We could have cap rate expansion. And the last several years have been so wild with that, where we've hit, in 21 and 22, the lowest cap rates we've ever seen. And then now it moved up, it's moved back down, it's moved a little sideways. It gets so granular into the market, into the, and when I mean market, I don't mean like MSA, I mean the neighborhood, the city, the town, every one of those little factors, the location of that piece of real estate, as opposed to another one that someone's willing to pay more or less, basis or cap rate wise. And even in that, there's like nuance where, there could be two deals that are right next door to each other and that trade at very different cap rates, even though they're all similar, just because of like the potential that someone sees in that. So there's so many things in that. So we have to take all that nuance into account and find where we want to put that risk on or risk off. If you buy a deal that either has a 4 cap or has an 8, right? So we looked at a deal last year. It was like a 2000s build. The basis was really strong. It was like 140 a door that we would have been able to take it down at, but the cap rate at the time was like a 4 on that number. But the reason was occupancy was really rough, bad debt was really high, all this other stuff, because the current management company, and that was owned by the seller, they had people that they had to fire because they were doing fraudulent actions for 6 months before that, right? So when you looked at T3, it was a lot more comfortable, trailing 3 months, a lot more comfortable in the financials. So we just had to come in there and clean it up, and then suddenly that deal would have been a 6 cap, if not better, by the time that we took it over and operated it well. And then on the other side, it's like if you can get in on a deal that's an 8 cap in place, just because they're running really high or really low expenses, where yours are going to be, but the rents are really low and you can move that. Well, that deal that's an 8 cap, if it's depending on the vintage and location, you could move that thing up to an in-place yield on cost, which is what we're always looking at, 10 or something like that. And the market might meet you there at a 6 or 7. And so if you had cap rate expansion in that, right, you'd be in a place that's not real to the market. But no deal is going to trade of this kind of caliber in this area for a 9 or a 10, especially if it's run well. You bought it in the opportunity of where it was, and now you're going to go to market, and that market's there. So putting that nuance into it is what we're always trying to do. And then, like I said, sensitivity analysis, those cap rates. So the 25 or 10 bip movements, 10, 25 basis point movements in that cap rate, to see how that performance goes. And if we have 50 to 100 basis points, which is a big, gigantic movement, and we're still returning some capital and producing some amount of return at that, we feel more comfortable about the performance of that deal long term.
Yep. So correct me if I'm wrong, but if we were to summarize kind of what breaks deals, like when you're stress testing, what typically breaks deal is multiple small misses that compound, revenue and expense pressure, and then just timing challenges. Sometimes the market just doesn't line up for a deal, and that's what breaks it during stress testing. Are there any other high level things that when you go through that are common things that will break a deal when you're underwriting?
Underwriting and then going into the transaction of it, it's like if you have a big miss on insurance or And this goes into like kind of what you do on due diligence, but like, there's electrical panels and there's small plumbing things that insurers will charge you far more for, or the way that the buildings are laid out. So you need to know that nuance and get your people in there early. Otherwise you could have an insurance miss by 100, 200 bucks a unit. And that's a big move. And then your taxes and like how you look at those, how you reassess, depending on what state we operate in. Kentucky's very easy, right? Like what you're going to get reassessed at because it's whatever you purchase it for, 95% reassessment. But in Ohio and Indiana, there's a lot of games you can play to try to avoid that. And so that it's kind of a mystery. And depending on how risky you want to play, you could bring that assessed value quite a bit down and pay up for a deal and win a deal. But if you get reassessed, and people do sometimes, at that full amount that you weren't originally anticipating, you're going to be in a world of hurt. Right?
Yeah. So I think for any, passive investors that are listening, things that they should focus on when evaluating an operator and when asking them questions about their underwriting process, about their stress testing process is how conservative are their assumptions? What is their margin of safety? And then obviously transparency from us, transparency from their sponsor, and then understanding what the downside scenarios are. Not only for the investor to understand those downside scenarios, especially if they're going to go through some headwinds and tailwinds with every investment over the period of 5 to 7 years, but also knowing that their sponsor understands what the downside risks are. So in my opinion, the best deals aren't the ones that look perfect, but they're the ones that still work when everything goes wrong, which is calling back to what you had said earlier. Like, if things are zero, are we still able to, keep this asset, operate this asset, and produce a return, even if it's a smaller return?
Yeah.
So stress testing a deal, again, isn't about being pessimistic, but it's about being disciplined and making sure that you have the right assumptions in place and have that good margin while not being too overly conservative. We've talked about that in previous episodes. Is there anything else that you thought that you would like to add when it comes to stress testing a deal, underwriting, and then into the operational side of it?
I think what you said there too, it's like, when people are evaluating it, I don't think that there's a sponsor out there that's saying that they're not conservative and that they're aggressive, right? I don't think that that's going to be the case. So when you're going into that, they're all going to say it is. It's understanding the reality of it, like going back to your point, providing evidence, talking through things with them, vetting out different stuff. It's like, okay, here's your rent growth assumptions. If they are 1 or 2%, I would just say that, yeah, generally they're probably conservative. It's when you see other numbers going on in there and where they're positioned, that's when you have to vet that out. And it's like, okay, why are you coming to this number? How are you coming with this number? And if the answer is CoStar, then you probably want to second guess your investment with those, if that's the only answer. But if they have local knowledge, local operations, they've proven it out on several other deals, that's probably really good. And then like maybe you are willing to take that risk. And so taking in that nuance and stuff, and you just want that background evidence, and then that they've thought through the different problems that could come up. To your other point, no deal, knock on wood, will, go perfect. It's going to have issues. And even when you start to hit your stride and you're breaking pro forma, there's going to be breaking pro forma to the positive, beating pro forma, there's still going to be issues that come up and ways that you can improve the property. So it's never always going to be sunshine and rainbows. There's going to be a crack in the wall or a plumbing leak that happens or a flood or a fire or something that you have to deal with. So you just got to know that the operator has experienced those things or has the systems and techniques in place. And that's just conversation to be able to figure that out. Because that the financials are going to, the pro forma and the financials are going to tie out in a point that, makes sense and at least a little bit and shows you a return that does. But you got to get into those numbers to really figure out and vet the different parts that move the needle the most.
Yeah. And beyond the numbers and some of the more advanced nomenclature for maybe a first-time investor, like maybe you don't know what the answer should be, but you can get a pretty good indicator on how the operator, how the sponsor is answering. Like you said, if they just give a one-line answer of like, oh, because of this, instead of saying, hey, here's how we thought about it, here's how we've gone through it, here's what we've experienced in the past in this market, and here's how we arrived to this number. Maybe you don't know that like a rent growth assumption should be within the 1 to 2% area. You maybe don't even know what the number should be, but if you hear the thought process, if you know that they're transparent in their procedures and methods, if you know that you can have confidence in them when there will be, headwinds instead of tailwinds, that they're going to communicate those to you and they know what to do in those scenarios. And so, maybe you don't need to be the most, financially adept. Maybe you don't need to be an expert in this. That's the reason why, for passive investing, but evaluate the people and evaluate the way that they're evaluating the deals.
Yep. That's exactly the right right way to look at it.
Perfect. Thank you so much for joining us.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.